Hey guys and gals, Shane Westall here from the Vortex Financial Coaching channel. Thanks for joining along. If you're one of those people that are drowning in debt, humiliated, frustrated, angry, ashamed, fighting with the partners, wives, husbands, boyfriends, girlfriends, then guess what? You're not alone. There's about 80-90% of you out there that are actually in the same boat but don't know it, because money is the least talked about subject on the planet. But I was divorced, I was broke, I struggled and struggled and struggled. I thought there must be a better way. And frustration and drive, I've spent hundreds of hours figuring out a way to do it. And I've done that. And I want to show you guys how to do this as well. So please, I'm not a very good presenter, but please stick with me. Stick through these videos. And ask questions in the comments below. Please like and subscribe, and we'll see you in the video. Cheers. Hey guys and girls, Shane Westall from Vortex Financial Coaching. Thanks for joining us today. So we're going to do a video on basically how to, just the tools and some acronyms around this system. So we're going to be using the velocity banking strategy, which is just basically the Vortex is the concentrated effort of all your cash flow paying off all that debt. So I'm just going to, just give me 1 second. I'm just going to get in and do this. Let's just see if we've got that. Yep, cool. Okay, so we're going to teach you how to pay. So I'm not a financial advisor, I'm not an accountant, I'm just an average person that's figured out how to get out of debt, and I've figured out the hard way. I didn't have anybody to help me. I've tried and failed a lot of times, and eventually I hit the nail on the head and figured out that there's other tools that the banks do not advertise about at all, that if you use a little bit differently, and I'll teach you how to do that as well. And it's a really powerful strategy. You spend a holics out there, this is probably not going to work for you. If you end up down that right at the end of the line and you want to change, then first of all you'll need to understand budgeting. I'm not here to teach you how to budget. I am here to teach you how to get out of debt fast. Mortgages, boat debt, car debts, credit card debts, all that sort of stuff. Business debts, yeah, all that stuff. So let's just get into it. So we're going to unlock the secrets that banks don't want you to know. And why do you think they don't want you to know? Anybody? Money. All money. Because if they figure out that, if they advertise this different method, it's a tool. They've all got this tool. But if they don't want you to know, because they're making hundreds of thousands, millions, billions of dollars on interest, and it's all front loaded, and it's all getting paid every day by everyone. So why would they change? A bank, you got to realize, if you're talking to a bank teller or a bank person on the phone from the bank, of course they're not going to recommend these other products, because they don't make as much money, and they work for the bank. Who does the bank work for? The shareholders. The shareholders want to make as much money as possible, so they don't want you telling a customer that you can use these other products, but it's not going to make us any more money. It's going to save you hundreds of thousands, but yeah, they just will not talk to you about that, and they'll try and talk you out of getting into these things. So welcome to the Vortex Financial channel. So yeah, I'm just a guy. I'm not an advisor. So please join me. I'm going to do a bunch of these videos, and I'm going to teach you how to get out of debt as fast as possible. Even if you're negative cash flow, so that means you have run out of money before the end of the month, and all the bills aren't getting paid, and you're ending up having to borrow more money to just get you to the end of the month. It's a pretty serious loop, a loop of despair basically. I've been down that road. It's not fun. You know, when you've got to hock off some of your gear, like your TV or your fridge or whatever, to try and get through to the next week to get the kids' lunches and stuff. It's not fun. So I'm not a judge and jury. I don't care how you got here. I do care about getting you guys and helping you guys to get out of this situation. So I want to teach you how to fish, basically. If I teach you how to do these things and how to actually figure this stuff out, how to do the research, then you will be much better off, and the relief that you'll feel once you start seeing some changes, you'll go, wow, why didn't I know this earlier? And I kicked myself. I wish I had known this 30 years ago. Anyway, in this video, we're just going to go over a few points here. In this video, we'll uncover many financial topics hidden by the banking industry. We will help educate so you can do your own research, come to your own conclusions, and come to understanding finance for your better futures. So the person that should be most interested in your money is you. So you make the decisions. Don't let everybody else control your decisions. You do the research, and I'll teach you how to do that. Simple math, it's numbers don't lie, and we're going to go through lots of examples in other videos, not this one. This one we're basically going to focus on acronyms and the different banking tools out there. So in this module you'll learn some new terminology to better understand this module and these videos, because you need to understand what these words mean, because if you don't understand what they mean, it's just going to be like blah blah blah. So just stick with it though. It's definitely going to have a massive impact on your life. Introduction into advanced financing tools like lines of credit, and understand how table loans and mortgages work compared to lines of credit. In other videos I'm going to do working examples of how to pay down a mortgage fast, and also how to pay down debts and credit cards fast. Feel free to ask questions, and as you've finished each video, there's no silly questions, so please feel free to engage and clarify at any time. If you're not sure, just ask down below. And also, while we're talking about that, again, thanks for tuning in. Please like and subscribe, and the more people that like and subscribe and put comments in, the better it is for the YouTube algorithm, or the algorithm, and it gets more and more people to see this stuff, and I want to help as many people as I can. So get ready to empower yourself with knowledge to take control of your financial future. I'm really excited for you guys, I really am. So understanding the tools of the trade, acronyms. It's important to understand some of the terms we'll come across in our financial learning curve. You can always refer back to these later, so forward, rewind, pause as much as you like. It's a great thing about videos that you can do that in your own time. So ADR, average daily rate, so is interest. So interest is what the banks charge you for the service of borrowing their money. And the more interest you pay, the more risk you are to them. So the higher the interest rate, the higher the risk is for them. So they want to charge you more interest or more of a toll for borrowing that money than someone that's got better credit, or they've got a house that they've collateralized, that they've actually allowed the security against the loan, will bring those rates down. So interest is calculated on the average daily balance. So that's what ADR is. During a billing period, lenders compute the average daily balance. So that's a sum of each day's balance at the end of the day, each day, or first, second, third, fourth, right to the 31st day of the month, and they add all those up, right? And then they basically times that by the annualized interest rate, and then divide it by 365. So we'll go through the examples anyway. I won't bore you with the stuff. So APR is the annual percentage rate. So is the annualized cost of borrowing expressed as a percentage. It includes interest and sometimes fees. So borrowers can compare loans across different products. So you can compare bank to bank because you can see the interest rate. Higher interest rate means you're going to be paying more sometimes. Check the terms and conditions, because they sometimes charge you a lot of fees, like processing fee, approval fee, 6 monthly fees, all sorts of fees. Have a look first before you start going down that path. You want to look for, if you're really, really tight on your finances, as far as like your ability to pay these, you want no fees if possible. But we'll go on to all this stuff later. Okay, annual percentage rates. We've just gone into that. Just a summary again. So a lot of table loans are fixed annual percentage rates. So that stays the same over the period of the loan. So if you do like borrow money for a car, for example, you will pay that, say it's over 60 months or 5 years. You agree, or you don't agree, you get told what interest rate you're going to get. They base it on your risk, and yeah, here you can have this car, it's only this amount a week, it's going to cost you 15%, but it's only going to cost you that much per week. So, oh yeah, I can afford that payment, no problem. And then they fix that rate in for 60 months, and yeah, away you go. We'll find out why that's bad for you later. For credit cards, also consider, so for credit cards, so they're lines of credit, or personal lines of credit, also consider grace periods. So that's the period before you actually start incurring interest. Some have 20 days, some have 30 days, some have 50 days. Cash out is 0 days. You pay interest, and usually cashing out, if you cash out, it usually costs a higher rate. So you can look at those different rates when you're looking into these tools. Low or no interest debt transfer, so you can consolidate debt by pulling it all into one credit card, and they have a low interest on that transfer. So if it's 5,000, it might be 1.99% or 0% for 6 months, 3 months, or 12 months, something like that. Again, look at the fees, because it might not balance out too good for you. So you just need to do some calculations on that. Just math, right? So some offer year points, free travel insurance, all sorts of other things, like they upgrade you when you go into the airports and stuff. You can get upgraded concierge service or bar service before you go. Some have, and a lot of credit cards actually insure your purchases as well. So LOCs, PLOCS, HELOCs, and credit cards, credit cards. I don't know what happened to the rest of that word. So I'll explain what these are in a minute, but these types of loans are what we call open-ended or bilateral loans, which means that you can pay money into them and you can also take money back out of them without penalty or punishment. So if you've got credit above, you're not at the credit limit. If you're at the credit limit, you won't be able to get anything out. But if you put in $1,000 and bring that credit card down from the credit limit, you can still take that out. So it's bilateral, so you can revolve that money in and out of that account. So the interest on these is calculated daily on the average daily rate, generally. What this means is the interest rate's calculated daily on the balance of the loan at the end of each day. So 31 days, each day, end day balance, after all your transactions are done, midnight usually, because there's a lot of online spending going on. Yeah. Some are secured, collateralized. So this is not talking about credit cards, but like with LOCs. So LOCs are a line of credit or revolving line of credit, which means you've got the two-way loan. PLOCs are personal lines of credit. Generally, I've not seen anything in New Zealand that does PLOCs at a bank level. They'll usually credit cards are usually the only one that do personal lines of credit. HELOCs are home equity lines of credit. So you're using equity in your house. And then credit cards. Yeah, so those four items are the tools that, are, in my opinion, far superior to standardised amortisation loans. Typically non-secured, so you get secured or collateralised, which is like a HELOC, the loan's secured against your house, or you're using the house as collateral. So if you fail to pay, the bank's going to take your house as collateral to pay down your loan. They'll take their legal fees as well out of it, and then they'll leave you take what's theirs, they've lent you, and give you anything. If anything's left over, you get that. That's not a good position to be in, by the way. It's not real good for your credit rating. But it's a good. The banks they're covered. You know what I mean? Normally, unless they're in a falling market where the house prices are going down, that's where they can get caught out. So they're basically, the higher the interest rate, the higher the risk you are to them. So if you've got like issues with your credit in bits and pieces, they will weigh that risk up and go, well, we'll give you money, but it's going to be at 27% because it's a high risk for us, and so they make it harder for you. So it's good to look at, and I can show you later on in one of the credit card videos how you can actually increase your credit card credit rating very quickly using just a credit card, even if you're struggling. But we'll go into all of this stuff in other videos, and lots of examples, so just stick around. Yeah, so interest rates typically range from 12.5 to 13.5 to 35%. I have seen one card, I think it was Amex, that was like 89%. Wow, crazy. HELOCs are secured against the house. Rates are usually 1.1 to 5% above the fixed national average bank rates. So when your Reserve Bank issues a 3.5% interest rate, your banks will go to 4.5 for fixed, and then your HELOC, which is on floating, will be about anywhere from 1 to 5% above that. Maybe a little bit less than 1%, but generally 1 to 5%. So line of credit, LOC or PLOC, or LOC or LOC or PLOC. PLOC's easier to say. It's a revolving loan allowing you to borrow up to a preset limit, repay and redraw. So income coming in, bills coming out. Income coming in, bills coming out. Interest is charged on only the outstanding amounts. LOCs can be secured with a HELOC, for example, or even gold. You can even use crypto now. There's some banks in the States that allow you to use crypto, especially Bitcoin or Ethereum or XRP. Those three usually banks are allowing you to secure against that now. It's starting to become more and more global, but it's typically in the States at the moment. So not in NZ yet, as far as I know. Or unsecured, often with variable rates and minimum payments. Home equity line of credit, we've gone through that. It's a revolving secured loan against the house as collateral. You can borrow up to a limit, and you're paying interest only on amounts drawn, often at a variable rate. Credit cards, again, another form of line of credit or a PLOC, revolving line, so money in, money out, income coming in, bills coming out, paid on the average daily rate. So the good thing is to drop your income in and then just let your bills come out naturally over that period of time. There's lots of strategies to do this, so I won't go into that now, but so again, the interest applies to the unpaid balances, and cards may offer rewards and protections. Interest is calculated on the interest daily rate. Amortisation loans. Some examples are homes, cars, boats, business loans, holidays, and everything in between. Most of the loans you'll see out there are amortised table loans, and everybody's struggling with these because no one's showing them any other way. Well, I'm here to help. I'm going to show you there is another way, and the banks aren't marketing this stuff because they don't want you to know, because you can save so much money, and they don't want that. So amortisation or table loans, which is your standard period 5-year loan, say for example for a car, and you pay monthly payments, scheduled monthly payments every month on the same day, every single month for the same value every single month. So and as you put money in, you can't take it back out again. So as your balance comes down, you can't take money out. Whereas with it's a non-bilateral loan. A bilateral loan gives you that revolving money in, money out. So you can, if you need something, you can get a little bit back out again. So once your money goes in, it's locked in the bank. So if you pay an extra payment of $5,000, you can't get that out. You're done. So they always tell you that too. Oh, you realise if you put this in, you can't get it out again. I paid 35 grand off a loan not long ago, a couple of months ago, in a hit amount, one amount, and they're like, "Oh, you sure you want to do this because you know?" I'm like, "Oh, don't you want my money?" And they're like, "No, just you can't get it out, right?" And I'm like, "Yeah, okay, I understand that." Anyway, yeah, which is not good. So just why consider a different approach to paying off your mortgage or loans? Mortgages can take decades to pay off. Most of them in New Zealand are 30 years. I'm pretty sure most of the world is similar. This system will work anywhere around the world. You just got to do the research on what your particular banks are offering and their terms and conditions. Significant interest costs over time. Did you know that in a 30-year standard period of a normal bank table loan or amortisation loan, schedule loan, you will pay more than the borrowed amount in interest? Don't believe me? Watch this. Mortgage 600,000, term 30 years, monthly payment, interest rate 5.5% per annum, total interest paid in 30 years $626,424.24, plus the 600,000 that you borrowed, so 1.26424 million. 1.2 million dollars. Wow, in 30 years. Yes, your house goes up in value. In New Zealand it's about 15 years. So in 30 years it'll go up twice. So from 600 to 1.2, from 1.2 to 2.4. But you've got to look at inflation as well over that period of time. It's just going up and up and up. So that's pretty much it. Like you can, in the similar, I mean, this sounds like a lot, but even in your normal car loans and other loans, you're paying a lot of interest, and it's all up front. Up front, like the first year, 98.5%. Don't believe me? Watch one of my other videos and I'll show you. Thanks for watching the video. I hope you enjoyed it. Please like and subscribe. Put your comments below, and we'll be right back. Cheers, Westy, over and out.